If I gave you $10,000 today and told you that you could only invest it in one ETF for the next 10 years, which would you choose? SCHD, one of the most popular dividend ETFs, or VOO, the ETF that tracks the S&P 500? Both have helped millions of investors build wealth. But after 10 years, which one would actually leave you with more money? The answer isn't as obvious as you might think. This is where many beginners get stuck. Some investors say dividends are the key to financial freedom. Others argue that growth beats dividends every single time. So who's right? Instead of listening to opinions, let's compare SCHD and VOO side by side and see how a $10,000 investment could have performed over a 10-year period. Let's start with SCHD. SCHD focuses on high-quality U.S. companies with strong histories of paying and growing dividends. It owns businesses with solid cash flow, healthy balance sheets, and a long track record of rewarding shareholders. That means you not only benefit from potential price growth, but you also receive regular dividend payments. If your goal is building passive income, SCHD has become one of the most popular ETFs for exactly that reason. Historically, it has also delivered strong total returns while offering a higher dividend yield than the broader market. Now let's look at VOO. VOO tracks the S&P 500, giving you ownership in 500 of America's largest companies. It includes many of the biggest names in technology, healthcare, finance, and consumer goods. Unlike SCHD, VOO isn't designed specifically for dividend income. Its biggest strength is broad diversification and long-term capital growth. Historically, the S&P 500 has been one of the most successful wealth-building investments for long-term investors. So, which ETF comes out on top? Let's put some real numbers on it. If you invested $10,000 in SCHD and it earned an average annual total return of 11% over 10 years, your investment could grow to about $28,394. Now let's compare that with VOO. If you invested the same $10,000 and VOO earned an average annual return of 12.5%, your investment could grow to roughly $32,473. That means VOO would be ahead by about $4,079. But here's something many investors overlook. What if you didn't choose just one? If you split your investment, $5,000 into SCHD and $5,000 into VOO, your combined portfolio could grow to roughly $30,434 after 10 years. So, here's the simple takeaway. If your priority is maximizing portfolio growth, VOO generally has the edge. But if your goal is building a growing stream of passive income while still achieving competitive long-term returns, SCHD stands out. Neither ETF is better for everyone. They're simply designed for different goals. So, which one should you choose? Choose SCHD if you want higher dividend income, you like consistent dividend growth, and you're focused on generating cash flow. Choose VOO if your main goal is long-term growth. You want exposure to the entire S&P 500, and you're comfortable with a lower dividend yield in exchange for greater growth potential. Or, you could combine both ETFs, one for growth, one for income, creating a portfolio that balances both objectives. Here's the biggest takeaway. The best ETF isn't necessarily the one with the highest return. It's the one that helps you stay invested for the next 10 years, because consistency almost always beats chasing the next hot investment. If you enjoyed this comparison, don't forget to subscribe and let me know in the comments, would you invest your $10,000 in SCHD or VOO, and why?